Welcome to Alpha Recap. Glad you joined us after the close. We've got a lot to unpack from today's tape. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. There was a ton of cross-market action today. Shorting in a big name, a bank pulling back on private credit, retail attention spikes, and a pile of company filings. Lots to chew on.
Let's start broad. Markets closed with a pickup in episodic volatility driven by two macro stories. Visa attracting heavy short interest, and JPMorgan Chase stepping back from lending to private credit managers after marking down some software loans. Ben, walk us through why those two things together mattered.
Sure. So what really stands out here is the interaction between equity positioning and credit plumbing. When a stable, widely held stock like Visa started getting materially shorted, you add a layer of positioning risk to an otherwise steady name. Meanwhile, when JPMorgan pulled back on lending to private credit shops, that was a liquidity signal. And liquidity is what often smooths volatility. Take both together, and you raise the odds of sharp moves across both stocks and credit.
Okay, for folks who might be newer to this, explain short interest in plain English. What does it mean when a stock becomes one of the most shorted in the Dow?
Short interest is basically bets against a stock. Investors borrow shares and sell them, hoping to buy them back later at a lower price. When short interest is high in a Dow stock, two things happen. One, the stock gets more sensitive to headlines. Bad news can cascade because those short sellers add downside pressure. Two, you also get the potential for loud rallies if the positioning flips and shorts rush to cover. So the trading moves can be larger than what the company's fundamentals might suggest.
Right, so more pronounced swings either way. And there's this technical angle about options and market makers too, I believe.
Yeah, exactly. High short interest often increases option market gamma exposure. Market makers hedge dynamically, which can amplify intraday moves. That's why a staple that historically behaved like a low volatility holding can suddenly move a lot more.
Got it. Now shifting to the bank side, JPMorgan's pullback. They marked down some software loans, then tightened lending to private credit managers. That sounds dry, but it sounded meaningful today. Why should equity and credit investors care?
It matters because private credit funds lean on banks for warehouse lines and financing. If a big bank like JPMorgan pulls in its support, it can force private lenders to slow deal-making or pay more for funding. That pushes yields up and spreads wider. And ultimately, that pressurizes the borrowers, particularly in sectors like software that carry higher multiples and sometimes more covenant sensitivity.
So this wasn't just an isolated risk transfer. It could ripple into deal flow and refinancing conditions.
Right. Some see JPMorgan's move as targeted risk management. Others see it as an early warning sign that liquidity conditions in that part of credit are tightening. If other banks follow, you could see faster repricing and deal slowdowns.
Quick reaction. That's worrying.
Yeah, that tracks.
Let's flip to the retail side. Oracle had a big attention spike today. You dug into the data on that.
I did. Oracle's search interest jumped dramatically. In conversational terms, there were about 20,000 Google searches and roughly a 200% rise in interest on the day. Now, that doesn't change fundamentals, but spikes like that can drive heavier trading volumes and short-term momentum.
20,000 searches and 200%. That's a lot of eyeballs.
Yeah, it was surprisingly loud. Attention-driven flows can create more intraday noise, and for traders who chase momentum, that's useful. For long investors, it's mostly just noise unless new fundamentals come through.
So, retail attention can be a leading indicator for volume and volatility, but you wouldn't use it as the sole reason to buy, right?
Exactly. Use it as an input. Combine search spikes with rising volume, options open interest, or an actual news catalyst before making a trade.
We also saw a raft of Form 8K filings today across a bunch of smaller names. Tredegar, Marpai, OppFi, BKV, GigaCloud, GameSquare, and On Semiconductor, ranging from routine exhibits to delisting and governance notices. Walk us through why that cluster mattered.
Form 8Ks are the real-time filing that can include anything from earnings to material events. When you get lots of them in one day, It raises idiosyncratic risk across the small-cap universe. For example, delisting notices like the one we saw for GameSquare are immediate liquidity red flags. Leadership departures and compensation changes at ON Semiconductor could change investor expectations. Traders who parse those filings quickly can get an information edge.
Short reaction. Parse those 8Ks fast.
Exactly. Triage them. Prioritize delisting, regulation FD, and items that indicate material operational changes.
Let's not forget biotech. Jacinta dosed the first patient in their phase 2 trial. That's a classic asymmetric binary event.
Right. Moving from preclinical to phase 2 de-risks early science a bit. For speculative holders, phase 2 readouts can be re-rating moments, but they're binary. Success can lead to big upside, failure to sharp downside. Position sizing matters here.
Short reaction, binary risk, size accordingly. I want to dig into the debate around Visa. Bulls versus bears. Summarize the two sides for our listeners.
Bulls point to Visa's durable cash generation, its network effects, and why it's been a low volatility staple in many portfolios. Bears say the rising short interest signals crowding and potential valuation pressure, and that a shift in payments dynamics, slower travel, increased interchange regulation, or more competition could force a re-rating. So it's a debate between long-term fundamentals and near-term positioning risk.
If someone owns Visa for retirement, what should they do? Panic?
No. For long-term passive investors, short-term noise usually isn't a reason to sell, but it's a reminder to be explicit about drawdown tolerance. If you want protection, consider modest hedges or rebalancing thresholds, not knee-jerk moves.
And for traders and quants?
Traders should watch short interest and options flow closely. Elevated gamma can create fat tails, both upside and downside. So size accordingly and respect liquidity widening.
Let's switch to practical watch list items. What should our listeners be monitoring this week after the close?
5 things. 1. Monitor short interest and options flow for Visa. That positioning can drive big moves. 2. Track bank commentary and syndicated loan pricing to see if JPMorgan's action spreads. 3. Use retail attention signals like Google Trends as an input, not a sole system. 4. Triage 8Ks quickly. Watch delisting and governance items. 5. Size biotech exposure for binary risk and watch enrollment and safety updates for Jacinta.
Good checklist. A lot of listeners manage different types of risk. Any tailored advice for credit investors?
Yes. If you're in credit or private markets, stress test your exposure to sponsor financing channels. Review covenant protections, especially for software loans, and prepare for wider spreads or slower deal flow. If bank liquidity tightens further, that's where repricing can be painful.
And for event-driven or activist players dealing with the 8K swirl,
they should parse filings quickly for regulation FD disclosures, delisting notices, and material governance changes. Those items can create mispricing or catalyst opportunities, but you have to read the exhibits, not just headlines.
Before we wrap, a quick synthesis. What were the top 3 takeaways from today?
1. Positioning matters. When shorts pile into a formally stable name, expect outsized moves. 2. Liquidity matters. A bank pulling back on private credit lending can transmit risk into deal flow and spreads. 3. Event risk is everywhere. Retail attention spikes, and 8K clusters create short-term noise and opportunity, and biotech milestones remain highly binary.
Solid. Any final practical tips for listeners heading into the next session?
Be explicit about why you own something and how much drawdown you can tolerate. For traders, respect the widened risk and manage sizing. For credit participants, retest covenant and liquidity assumptions. And for speculative biotech holders, use milestone updates as your triggers to reevaluate position.
Great rundown. Thanks for that clarity, Ben.
My pleasure.
All right, listeners, that's a wrap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll see you after the next close.